Welcome to the Lansing Regional Chamber of Commerce Policy and Regulatory Education Series. This is the Paycheck Protection Program, Round 2, with our friends from Raymond, our two panelists, Tom Szymanski and Andrew Rose, who are going to walk us through the PPP Round 2 and everything that goes into this Round 2. And there may be a Round 3. But today we're here to talk about Round 2. So just for all the attendees that are participating today, just as a reminder, this is a webinar format. Everybody's on mute. There will be time for questions during the program. I know both Tom and Andrew do a great job even during it. If you have questions that they try to get an answer, but they have tons of great information that hopefully, we know they will be able to answer any of those questions. This program is being recorded. We'll send this recording out following the program. It'll also be on the Lansing Regional Chamber's website on the Webinars on Demand tab under Media. And then, of course, the operator, myself, I'll when we share the PowerPoint screen, I'm going to hide myself, but I'm going to be here to support Tom and Andrew from behind the scenes. So with that, I think Tom's going to lead us off. I'm going to share the PowerPoint screen. And again, thank you all for being with us today. And thank you to Tom and Andrew for your time.
All right, good morning, everyone. Thanks for joining us today to talk a little bit about where we're at with the CAA Act that came out, which contained a lot of things in it, but today we're going to focus on kind of PPP2 and some of the tax implications related to that program. So let's kind of just jump into it. So there's your two presenters for today. Again, my name is Tom Szymanski. I'm a principal at Raymond. I focus in the CFO advisory space, fractional CFO work, and Andy Rose, who's in our Lansing office, heading up our Lansing office in the advisory and tax group. So we thank you for the opportunity to share some information with the Lansing Chamber this morning. So PPP2, yeah, I thought we'd run through. We've got a couple slides just on, how much dollars do we have, where are we at on the timing process, and then just some of the changes that are out with PPP2 that we just kind of walk through and that illustrate some of the differences between the first draw and the second. So go ahead, next slide. So again, $284 billion is what's been approved. Again, a lot of people are looking at this as the second draw, but if you hadn't applied before, you still are able to file through the end of March for a first draw. So that is something that that you have the ability to do now that maybe during the first time you didn't for whatever reason. Now you think you need to. There's separate applications for a first draw versus a second draw, but that first draw is still available. So, the SBA and all the banks are gearing up. We go to the next slide. We're just going to talk about the timing of kind of where we sit today. So there were some community financial institutions, which I think there's 34 in the state of Michigan that did start to open up with some applications last week for some certain segments of the minority business community. And those started the first part of last week, and then banks under $1 billion in assets opened up their portals and accepting applications last Friday, but the majority of banks will be opening tomorrow. So, you should all be in contact with your lenders. I assume, in a lot of cases, it's going to be the same, whether it's portal or whether your bank just accepted the application via email. That application process should be very similar this time around as was with PPP1 if you completed that loan. So let's kind of dive into some of the specifics on PPP2. Next slide. So, this latest act really kind of expanded upon the first PPP program. So, if you're a 501c6, those are organizations that weren't eligible before, but now are eligible. Again, so those organizations will be able to file a draw one type application. But I think the biggest thing is the second draw, was added, and that is really where if you got the first application, you're able to fill out a second. A couple differences with that is that there's a $2 million cap on the second draw, and for corporate groups or affiliations, that's a $4 million aggregate. So that was something that is added as well. So again, for example, if you were $1.5 million on your first PPP loan, you can get $1.5 million on the second. So that $2 million is not an aggregate in combination with your first, but it's simply a cap on the second. If you got a $4 million PPP loan on your first draw, that's where you would run into that cap. You would only be able to get $2 million on your second PPP loan. Another expansion area has been with the NICS code 72. A lot of our hospitality restaurant type businesses, that calculation that on PPP1 was 2.5 times the 12-month average payroll is now 3.5 for that NICS code. The only thing that I know is concern for some is that there is a stipulation that you need to have spent PPP1 or will spend it before receiving proceeds for PPP2. So in some of those restaurants or some of those venues where it's continued to be closed and you really haven't even spent the dollars, that's probably where you need to get with your advisors and see, well, is there a way I can spend the dollars, maximizing the 40-60% split on payroll, non-payroll, and get those dollars spent, because that is a requirement of this PPP2. They have expanded the forgiveness cost categories. Again, they did not change the split, the 60% minimum for payroll, but on that 40% non-payroll, they did expand what those costs could include, which includes certain operating expenses, supplier costs, property damage from public disturbances, and worker protection (PPE) type supplies. So I think for most, there wasn't. It probably wasn't as challenging to get to your 60% payroll. So this might be an area where you could get some of these other expenses rolled in. Another change with PPP2 is that now bankruptcy. If you are in bankruptcy, you are eligible to apply, and that this loan would be treated as the administrative claim. So that does give that preferential treatment and protection, for the SBA and the lenders to be able to put the PPP2 into bankrupt companies. So and then another big one was the EIDL grant dollars up to 10,000. That has always been historically offset against the PPP calculation. That will not be going forward, and for existing loans. So if you did file your forgiveness, already got your forgiveness for everything other than that 10,000, it appears that the SBA will be working directly with lenders. The SBA will be funding that 10,000 to lenders. Then you should see, a refund if you started to make payments on that. Or just a cancellation of that note balance once they receive that 10,000 back from the SBA. So now some of the restrictions. There are some restrictions. Yeah.
Hey Tom, before you move forward, on that expanded list of items you can use for forgiveness for expenses, if I'm just now applying for forgiveness for round one, can I use those for round one, or are those only for round two?
You can use them for round one if you haven't applied. If you've already applied, at this point, they're not accepting, revised applications. So, but I think for most cases, if you've already applied, you've already got 100% forgiveness generally. So
right.
So it is something they're not they're not revising first round applications if you've already filed them.
Okay.
So some of the restrictions on the second round is the two main ones that I think everyone's heard of. It's less than 300 employees. That was a drop from PPP1, which was 500. And then they also added a 25% revenue decrease test, and that needs to be a 25% decrease in revenue comparing any quarter in 2019 to 2020. And again, so another thing to point out is that, you know, the affiliation rules have not changed from PPP1 to PPP2. So the addition of this revenue test, you know, would follow those same affiliation rules. So you don't, you know, have the ability just to carve out one entity and say, hey, you know, this one entity, you know, had less than 25% if all the other entities in that affiliated group did not. And again, and I already mentioned the restriction that PPP1 has to have been spent before receiving PPP2, and they've referred to gross receipts. The revenue, what's in revenue is covered under an existing SBA definition, which is a 13 CFR 121-104. It's a pretty broad. It just says basically any gross receipt, you know, including rents, royalties, you know, and any kind of other income type things are included in that. So it is a pretty broad-based definition as far as what receipts are. I think one of the big benefits of this latest act is it's really attempted to streamline some things. The first is the loan application. If you're using your same 2019 payroll information and you're using your same bank, there's no need to supply that payroll information again. So you can literally, you know, use that same average monthly payroll times 2.5 or 3.5 for NICS 72, and you don't need to resubmit all that information because the bank theoretically already has it from your first application. So what you will need to provide is that 25% revenue reduction. So if it's a simply quarterly financial statement, you know, for example, Q2 versus Q2, that's all you need is one quarter. So just, you know, supply that supporting information for 2020 versus 19 to demonstrate that 25% revenue reduction. The other thing is they have expanded once, you know, the forgiveness application, the simplified version from 75 to 150,000. So again, that's a simplified 2-page document that's more geared towards just, you know, attesting to that you meet these requirements and that, you know, you spent the dollars appropriately and you attest, you know, you expect 100% forgiveness. Now, while it is a simpler form, this recent guidance did outline that, you know, all these supporting documents to support the forgiveness calculation, depending on the document, need to be retained 3 to 4 years. So, you know, just don't have the, there's a term that was thrown out, over the last 6 months, like auto forgiveness. And that's really not what this is. It isn't an auto forgiveness. It's just a simplified forgiveness application. But the SBA does expect that you understand that you've reached 100% forgiveness and that you've retained the records, the payroll records, the supporting records, that, you know, if the SBA wanted to come back and review your file, that you'd be able to provide that information. So, so it streamlines the filing, but really doesn't change your need to validate your expenses and retain that supporting documentation. So, so that's just kind of an overview of some of the differences in some of the requirements of PPP2 versus 1. Why don't we jump to the next slide?
Tom, before you jump to that next one, so it's not uncommon for a business to be on accrual for, say, their internal financials, but yet from a tax perspective, they use the cash basis method of accounting. So do I have the flexibility to use one or the other, or do I have to use my internals, or?
You know, I haven't seen any specific guidance on cash to accrual. I mean, I think you need to be consistent with whichever, you know, you wouldn't be able to compare a cash basis versus an accrual year to year. So, okay, you know, you're going to have to be consistent on your comparison.
Yeah.
but I haven't seen anything specific on whether you could use a cash basis or a tax basis versus your accrual basis. So
Just be consistent.
I guess yeah, be consistent. So there are new forms out. There is a new PPP1 application and PPP2, or I'm sorry, a first draw application and a second draw. And there's also been various interim financial release, documents. So all this stuff is on the SBA website. But if you go to the next page, in this presentation, we do have links to the various documents. I believe we can click on that application to the far right, Steve, and I think that'll open up another window. We'll just see if that does or not. But if you haven't seen the application, they're pretty straightforward. It's a little hard to see on this form, but when you get the PDFs, or if you download the PDF, right in the middle of the section of this form, it really just talks about which quarter, it's asking you to identify which 2 quarters are you comparing, from a revenue standpoint that's documenting that 25%, reduction. So, and it's just a standard 12-month average payroll times 2.5 or 3.5. So it is a very straightforward application. Like I said, those, again, it's going to be the same process. So if your bank was using a portal, you can probably assume they're going to be using the portal, collecting the same type of information. If your bank was just taking a PDF of the application, that's the stuff you can start to prepare for as this thing opens up tomorrow. And I think it's just something we're going to be paying attention across the next 2 to 3 business days, just to see what the processing timing looks like, how quickly funds are being distributed, and things like that. So I think it's just kind of staying close with your bank and making sure that you understand the process, and you're just keeping an eye to make sure that there's nothing missing or nothing someone's waiting on. So if you go to the next page. So a couple new grant programs. There's a couple things that we're going to talk about beyond PPP2, because with some things, there's some things that can work with PPP loans and some things that can't. One thing that can is the state grant program. So there's 2 survival grants that are going to be opening up, one tomorrow and one on Thursday, with some grants that the state of Michigan has rolled out, that are kind of geared towards the hospitality, the live venue, entertainment type businesses, but kind of those businesses that were significantly impacted by the various government orders, and that really have been significantly shut down over an extended period of time. So there's links on both of these to get into the specifics. They're generally geared towards small businesses. I think they were both less than 100 employees, but each of these links take you through to each program, and you can kind of walk through the specifics. But these are a couple good programs that could be a fit for your business, depending on your situation. So, another thing that came out, if we go to the next slide, is the economic injury disaster loan. So this was a program that had been out right away, same time as PPP1, but they got funded an additional $20 billion. So one thing that has changed, that they are, they ran out of the money for the grants, I don't know, 3 months ago or so, and so they've refunded some of that, but it's more targeted going forward. So there is the $10,000 grant is going to be available for a priority group that they've identified. And so if your business is located in a low-income community, kind of defined by the new market tax credit, I believe that link will take you to a section that has some maps available to see if you were in those areas. If you experienced revenue reduction in an 8-week period and you have fewer than 300 employees, then this $10,000 grant is something. If you didn't get in on the grants the first time, it is something you could get. The other feature of this is, let's say you were a small business. The first grant was based upon headcount. So if you only had 2 or 3 employees, you only got a 2 or 3. It was $1,000 per employee. Now you can kind of go back and request the delta. So if you got 2,000, you could get an additional 8 if you meet these criteria. So I think there's just a little bit of research you need to do to see if you qualify and get engaged with this process. What I haven't seen yet is what they're doing on the loan side. You know, the loans, the most recent loans kind of had been fixed at 150,000. I saw some reference to 50,000, but it wasn't quite clear if it was only related to these particular, you know, companies or if that was a new amount. So that's something we're kind of keeping an eye on to see what's going to roll out as far as changes. But there is additional dollars there, and I think this is something in the next 30 days we'll see some additional guidance. So again, this is another program that can work with the PPP program and is another potential access point for funds. So go to the next slide. The last one I want to talk a little bit was the Shuttered venue operator grant. Now, this one you cannot use in conjunction with PPP2. So this is one where you need to analyze this program and compare it with PPP2 to see which is more beneficial for your organization. But again, this is more geared towards, you know, businesses that you know, were more completely shut down. You know, it's a smaller program. It's got $15 billion. You know, but it kind of runs through the types of businesses that this really applies to. You need to have had earned 45% of your gross receipts. You know, and there's some ranges of you know, where you can fit into this program. So this one is brand new. It just was in as part of the first act. So they're still rolling out kind of some of the specifics. So it is something that you know, you need to, if you think this might apply to you, you know, you need to kind of reach out to your advisors and dive into a little deeper as more guidance comes out on it, just to make sure you understand, you know, what's more valuable to my business, you know, potentially this Shuttered venue operator grant or a PPP2, you know, loan that has forgiveness potential to it. So, but this was a new concept that was rolled out with the recent CAA grant or bill. So, so I think really from programs and from the PPP side, I think that's kind of where we're at. You know, I think we're still you know, waiting on some guidance in some areas to get into some of the specifics, but I think there's enough information out there for most borrowers to be able to fill out their PPP2 application with their lender, you know, and get into that program. And the only ones that should be, you know, maybe pausing as it opens up tomorrow is if you're eligible for the Shuttered venue grant, and if that's something you need to take a look at or not. So I think with that, we can go to the next slide, and I'm going to pass this over to Andy.
Thank you, Tom. So as Tom mentioned at the beginning of this, I am a principal and advisor at Raymond with background in tax. And I am going to take you through some of the more important tax provisions that were in the Consolidated Appropriations Act. There was quite a bit in there, but I'm not going to go through everything, just the things that are probably more pertinent to everyone. So if you could hit the next slide, Steve. Okay, so these are the stimulus payments that I believe are coming out right now. They're already in progress, so maybe some on the call already have received their stimulus payments. It is $600 per eligible individual. So a married couple filing a joint return will see $1,200 in these payments, and another $600 per qualifying child on your return. So you know, a family of 4 can expect about $2,400 coming to them And this one, much like the last one that was back in second quarter of 2020, there are phase outs on this one. So for a single filer, starting at 75,000, you start to see a phase out. By the time you get to 87,000, you're not eligible for the stimulus payment. And for a married couple filing a joint return, your phase out starts at 150, and by the time you reach adjusted gross income of 174,000, you are no longer eligible for the stimulus payment. So it is worth noting that if you did get an economic, I think they referred to them as an economic impact payment back in 2020, that doesn't necessarily mean that you can expect to see a stimulus payment. There was a carve out where at that point in time, a lot of people had not filed their 2019 tax return yet. And so you had the ability to use your 2018 tax return for the IRS to base those payments on. So if you happen to be, if your income was down in 2018, you might have gotten that economic income payment. If by the time you filed your 2019 tax return, your income had increased over that previous year, you could, again, possibly not be qualified for the stimulus payment. It's all going to depend on the numbers in those two returns. So just be aware of that. I think it's a good place to point out too, this is where there was some back and forth going on before this was signed into a legislation that, they wanted 2,000, they only got 600 in that 1.9 trillion, yes, that is trillion with a T, package that Biden is touting right now. There's an extra $1,400 stimulus payment. So that, if assuming that gets passed, that on top of the 600 would get to that 2,000 that they had originally requested. So again, that's not, that's just being floated out there right now as an additional package that might get some traction with the incoming president and Congress in Washington. So just be aware that's out there. Student loan paid by employers. This was extended. So an employer can pay off up to $5,250 on an annual basis on behalf of an employee with regards to their student loans. So that's extended through the end of 2025. And again, that's $5,250 per year. Next slide. Charitable contributions got some changes. They originally were changed by the CARES Act, and they just got changed again through the Consolidated Appropriations Act. So non-itemizing individuals. So if you happen to be one of those tax filers who does not file Schedule A or does not itemize, you can take up to $300 on page 1 of your tax return for charitable contributions. And if you do happen to itemize, the income-based limitations have been lifted for 2020. So in the past, your contributions were limited to 60% of your adjusted gross income. That 60% is now 100%. For 2021, the 300 goes to 600 for a married couple filing joint. So that 300 on the 2020 return, doesn't matter if you're single or married filing jointly, it is $300 tops. For 2021, that goes to 600 for a married couple filing joint. And again, those limitations on the adjusted gross income have been lifted. So again, 60% becomes 100% of your AGI. Anything above those would be carried forward. You don't lose them, you just continue to carry them forward to the next succeeding tax year. Extension on repayment of deferred employee payroll taxes. So this was the ability to receive a no interest loan from Uncle Sam on the employer's portion of Social Security taxes. And so this, I believe, this is, I think 50% of this is due December 31st, 2021, and then the other 50% would then be December 31st, 2022. So this was extended under the Consolidated Appropriations Act. So just be aware that that's out there. I don't know how many people took advantage of that, but it was an additional way to conserve cash. And it does not extend the, oh, I'm sorry, that President Trump's, that's the thing that I don't know that I don't have a client that took advantage of that. That was where President Trump had allowed employers to essentially defer the employees' payroll tax until some future time. So that got extended, which again, I don't know that anybody took advantage of that. There was just too many concerns with that provision. And this does not extend the deferral under the CARES Act. That's what I was originally talking about. So if you deferred your Social Security tax payments under the CARES Act, that is not changed, and you still have 50% due December 31st of this year, and the other 50% is due at the end of 2022. Sorry for that confusion. Next slide, please. Some of the other changes in the Consolidated Appropriations Act. So made permanent is the 7.5% floor on unreimbursed medical expenses. So if you do happen to itemize, there is a floor upon which you cannot deduct your unreimbursed medical expenses until you get above and beyond that floor. And so that floor is now 7.5%, and that's been made permanent. Anything above and beyond that 7.5% is deductible on Schedule A. The $250 educator expense, it's been around for a while. It's been changed so that now you can also include PPE into that $250. So I have a few teachers that take advantage of this, and I always hear from them on an annual basis that $250 is way too low, and they blow through that pretty quick. So the mortgage insurance premium deduction has also been extended through 2021 for those of you that have PMI, and the $500 lifetime non-business energy property credit is extended through 2021. So that $500 is a lifetime cap. And some of the things that qualify for this would be if you replaced doors, windows, insulation, and it has to be on your primary residence. So if you happen to have those expenditures and you've never taken the $500 credit for it, you might want to talk to your advisor about that. 2020 refundable portion of the child tax credit and the earned income credit can be based on your 2019 income figure. So for those of you that maybe your 2020 income was higher, you may want to look back to your 2019. Just be aware that you can essentially optimize between 2019 figures and 2020 figures for those credits. Unused flex spending account balances can be rolled over in 20 and 21. And I believe that's limited to 500 or 550, one of those two. I think it's 550. So you have the ability to roll over $550 from one year to the next if you didn't happen to use all of your flexible spending dollars. And that rollover does not in any way adversely affect your limitation for that year either. So, you know, you're still able to put away $2,500 in there, even though you may have carried over $550. Next slide. Business tax provision. So this was what we were all waiting for. So for those of you that did have a PPP loan and had it forgiven, you are now able to, you know, we knew if you go back to when the CARES Act passed, we knew because of the CARES Act that those PPP funds were not going to be taxable income upon forgiveness. So that was clear. What was not clear at that time, or maybe it was clear, you know, from a congressional standpoint, but the IRS certainly did not agree, was whether those expenses that you paid, so let's just say it's all payroll, you used your PPP funds for payroll expenses, we were never certain that we were going to be able to deduct those expenses. And typically what happens is if you get a grant or tax-free income, you can't take the expenses associated with that tax-free income as well. It's kind of it's the equivalent of double dipping. And so we were waiting for this all year, and finally at the end of the year we got what we were hoping for, and those expenses are now deductible. So this was going to create some pretty disastrous results depending on when you applied for forgiveness, when you got your forgiveness. And so the ability to deduct those expenses was a pretty massive piece of legislation that came out. So again, it just overrides previous IRS position. Previous to that, the IRS came out and had said that they were not going to allow them, but that has been reversed. For those partnerships and S corps that are out there, you've got some unique complexities that this is going to bring with regards to determining your basis. And basis is a fancy way of saying how much you have invested in your business. And basis is always something that we have to look at to determine whether you can take money out of your business. It's an annual maintenance type of calculation that gets done. So if you have questions on basis, it's best to target this question towards your tax advisor, because this gets pretty complicated. So we're still in need of some guidance because the way we understand it right now, there could be some timing differences that might not turn out. I'll give you an example. So the ability to deduct those expenses that I just told you about, you might not actually get any benefit from that in 2020. You might not get the benefit from that until 2021 on that tax return. So again, this is pretty complex stuff, and you need to be having some conversations with your tax advisor on this. EIDL grants and SBA loan payment assistance. So those are going to get the same treatment as the PPP forgiveness. So those, if you did get an EIDL grant, it's not taxable. Whatever you used it for, you can deduct those expenses. And the same thing with the SBA making loan payments on your behalf. No income due to loan forgiveness. Again, not only are the expenses deductible, but those are not taxable to you. So just like the PPP forgiveness, those would be tax exempt income items. Next slide. Well, this is something that was certainly interesting. I think President Trump had joked around about this at one time, or had asked for this, but I don't think anybody thought we were going to see this. But business meals will be fully deductible in 2021 and 2022. Yes, you heard me, fully deductible. No longer are they subject to a 50% limitation for those 2 years. So I think it's key to point out, I don't know if that, yeah, so see that the word by, it's important to distinguish deduction for business meals for food or drinks provided by a restaurant, not in a restaurant. So this would be if you're, happen to be bringing in food for your employees, or you're bringing in food for a business meeting. It does not actually have to be that you're spending this money in a restaurant. So just a small nuance there that I thought was worth pointing out. So I'm sure the restaurants are happy to see this provision. We have some additional time on the Family First Coronavirus Act, paid sick leave and paid family leave credit. So you now have until March 31st, 2021 to continue to see some benefit from those credits. So if you happen to have somebody that is off from work because of one of those items, either the sick leave or the family leave, that has been extended. Let's see here. Other business provisions. So the work opportunity tax credit for those of you that that get some benefit from that, that's been extended through 2025. And if you aren't aware of what the work opportunity tax credit is, something that you should certainly be looking at. It's a benefit for hiring certain disadvantaged employees. So, you know, felons and I think certain veterans are included in that. There's a list of people that would qualify. So if you happen to hire one of those individuals, there are credits that can be attached to that employee. Energy efficient commercial building deduction, so this is commonly called the 179D deduction, has been made permanent. And this was something that every year we were not sure if we were going to have it for the following year. So that's been made permanent, which is good. The alternative fuel credit has been extended through 2021. So that's a credit for using certain fuels like propane, hydrogen, some of those other unique alternative fuels. Look-through rule for controlled foreign corporations has been extended through 2025. It's really going to be an international provision. So if you have international operations, you're going to want to be aware of that. And for any farmers out there, farming net operating losses are eligible for an election to retain the 2-year carryback period rather than the 5. So in some cases, if you do have an NOL, you'd wish that you could go back only 2 years. But unfortunately, most people have to go back all the way to the 5th year. Farmers, however, can make an election to go back only 2. Next provision. I'm sorry, next provision. Next slide. CARES Act overview. So this is the employee retention credit, and this was a big change in the Consolidated Appropriations Act. So this is the refundable tax credit up to 50% of eligible wages from March 13th to December 31st of last year. So it has now really kind of been carved up into 2 different employee retention buckets. So you got 2020 and you got 2021 now. So there was a test on whether you could use this back in 2020. So you had to be carrying on a trade or business, and you had to have some kind of it didn't have to be a full shutdown, but you had to have some kind of a impact to your operations by way of the government shutdown, stay-at-home orders, or you had to have a 50% reduction in quarterly gross receipts. So this is kind of similar to what Tom was talking about earlier about looking at your gross receipts and comparing it to the previous year. So you had to have one or the other in order to take this employee retention credit. And there were different rules. So if you had 100 or fewer employees, you had less hurdles to clear than if you were more than 100. And it was only, it was capped at $10,000 of wage expense per employee for the entire year. So once you had an employee hit $10,000, that was it. There was no more credits associated with that employee. So, and then also this is big too. Under the CARES Act, you could not take the employee retention credit and take a PPP loan. So this was a big disconnect because I can tell you that almost every client that I work with took some kind of PPP loan. So I mean, this was, once we read that, it was kind of like, okay, well, let's pay attention to some of the other tax provisions because this is out of the realm of possibility. Well, it is now a possibility. So next slide. So what the Consolidated Appropriations Act changed was that the credit is extended through June 30th of 2021. And this is big, so listen to this part, is PPP recipients are now eligible retroactively to use wages. However, you cannot use wages that you used for PPP forgiveness. So Tom and I were talking earlier about this. This is something that we do not, as of this morning or as of the start of this presentation, have guidance on in terms of how this is going to work. But essentially, if you qualified for the employee retention credit back in 2020 and you didn't use those wages in your PPP calculation, you potentially have the ability to take this credit now in 2020. So when this guidance comes out and we get more clarity on how that is all going to work, this could end up being some pretty significant dollars for businesses and taxpayers if the numbers work out right. So this also, I said before, this creates two buckets. It creates 2020 employee retention credit, and it creates a 2021 employee retention credit. So in 2021, we know that you can take this and take PPP. So if you happen to be going for round 2 of PPP, that no longer prohibits you from taking this. But the increase in the credit rate goes from 50 to 70% in 2021. And it is now, instead of a $5,000 credit, it is a $7,000 credit per quarter. So if you happen to, and I'll go into an example here, if you happen to have an employee that that qualifies for, if you qualify for this and you have $10,000 of wages in a quarter, you can take 7,000 in that quarter, and then let's say in the next quarter you have another 10,000, you can take it in that quarter as well. Big distinction there, because you were limited to 10,000 per year in 2020. So these are some nice changes to this credit for those of you that qualify for it. There is a gross receipts test here as well, just like there was in 2020, but it's been dropped from 50% to 20%. So comparing a quarter of 2020 to a quarter of 2019, you need to have at least a 20% reduction in gross receipts. And the employee threshold for 2020 was 100 employees. It's now 500 employees. So if you happen to be under 500 employees, you get the more flexible employee retention credit rules. Again, this is just a disclosure here that we're waiting on guidance. We don't know how this is going to work. So the fact that you might have used some wages for your PPP forgiveness that you might have otherwise been able to use employee retention credit, we don't know how that's going to work. If you can somehow go back and get a do-over, or submit an amended PPP application, we have no idea how that's going to work. Next slide. I think this is the example. Yeah, so okay, this will kind of hit home with what I just told you. So assume taxpayers qualify for each period and one employee. So for 2020, in quarter 2, you had $10,000 of wages, qualified wages. And so 50% of that would mean that you have a $5,000 credit for quarter 2. In quarter 3, your wages that were qualified dropped to 8,000. So because you've already used the 10, and again, this is one employee, because you've already capped out at 10,000, you have no credit in quarter 3. So your total credit for 2020 on that one employee would be $5,000. For 2021, you're going to start to see where the numbers can add up here. In quarter 2, you had 10,000 again of qualified wages. And so because now it's 70%, you got a 7,000 credit in quarter 2. So that same employee in quarter 3 had 8,000 of wages, where before you had a 0 credit for that quarter, you now have a $5,600 credit. So your total credit under the new rules for 2021 would be $12,600. Pretty substantial change. So again, be aware that this is out there, and also be aware that we're waiting on guidance. This could end up really adding up to some nice dollars for some businesses, and it might not have been available to you to begin with before the change. So I think that might be the last slide, but if you could advance it, Steve, please. Oh, sorry, there's one more. So in looking at this, in a multi-step approach to it, one, you're going to want to make sure that you're eligible. So again, that's looking at that test, first determining whether you had 100 employees or you happen to be over 100 employees, because it's a different test. So taking a look at that, and then assuming that you qualify under step one, you need to figure out what your employee count is. Again, this is gonna kind of point you in one direction versus the other. At that point, once you kind of figure out what bucket you're in, you're going to determine whether you have qualified wages and what those qualified wages would be per employee per year or per quarter in 2021. And again, remember, you can't use the same wages. So if you used wages for PPP, you can't use those for employee retention credit as of now. And then claim the credit. And the way you claim the credit, there's a Form 7200 where you can essentially request a kind of an accelerated refund, or you can take the credit on your quarterly 941. Next slide. I forgot about this. So this is just an insight into the Biden tax plan. So for any of you that have heard that, one of Biden's platform issues that he campaigned on was that he is going to raise taxes. And so he's been pretty clear about that. And so his magic number is pretty much anyone over 400,000. So from an individual perspective, tax rates would go up for those making 400,000 or more. They would actually go from the top rate of 37%, which is the current top rate, back to pre-Trump, which was 39.6. And that would apply basically at that point that someone goes over 400,000. They would then be subject to the higher limit. This is something new too. So there's always been a cap on Social Security earnings. So once you hit a certain amount, I don't know what it is for 2020, around 130, 140,000, you are no longer subject to Social Security tax. So there would be actually a kind of heard it called a donut hole. So you would hit a point where you would reach that limit and you would not owe any more Social Security tax, but then once you get to 400, it starts again. And there would be no limit on it. And that would be employer Social Security as well as employee Social Security. So both of them, the clock would start ticking again. The value of itemized deductions. So, not too long ago, that itemized deductions were limited. They would become so again for more. I think this one's tied to 400 as well. So if you happen to be in a $400,000 income range, your itemized deductions would start to lose value. This is the big one that I think most people, this was what they were talking about. So capital gain rates for anyone earning more than $1 million would become ordinary tax rates. So what was once maybe a 20% tax rate would then become almost 40% tax rate. I think what's unclear is it a cliff? So once I hit $1 million, I lose all of my capital gains are taxed at the highest ordinary income rate, or is there some kind of a more softer landing, some type of phase in? We don't know yet. Potential estate tax changes would be pretty massive. So you're currently able to your lifetime exemption is just under 12 million. So you can basically die with $12 million in assets and not have an estate tax bill. Under Biden, I believe he's talking about taking that down to maybe 3 million. I've seen $1.5 million. I've seen 3 million. I've seen a couple numbers. Substantially less than 12 million. And the basis step up at death would be eliminated. So as of right now, if you leave property to an heir, it gets stepped up to the fair market value at the date of death. So I bought a piece of land for $1 100 years ago. I die, it's worth 100,000. I leave it to my son. The basis is 100,000. He turns around the very next day and sells the property, has no gain. That would go away. So In that example, on the very next day, when my son, sells that property, he's got $100,000 gain. So you can see where these are some pretty substantial numbers for those people in this rare air. Expands, reinstates, and establishes new credits. So I've taken a look at some of it. There's a lot more bang for your buck on a lot of credits out there that are already in existence. They just get new life and get supercharged, if you will, under a Biden presidency. This first-time homebuyers credit is new. I think that would be like $14,000 or $15,000. That would be applicable to someone buying their first home. I thought I saw something on it that would get paid directly to the title company. So I'm not, we don't have the weeds or the details on any of this stuff. So how it would work, I don't know, but I did see something that would be a direct payment to the title company. From a business perspective, we've had 21% as our rate for a while. It would go to 28% for C Corps. And qualified business income deduction would be lost for those over 400. So that's a 20% deduction right now on income flowing from an S Corp or a partnership. That would be gone for anyone over 400. And this is kind of it's right here, the new alternative minimum tax. So there would be this minimum book tax that if you have a certain amount of assets or income, you would be, so let's say you had a loss, you're not going to escape tax altogether. So again, we don't have a whole lot of details on how it would work, but that's a pretty sizable company with 100 million or more in net income. This is an international provision, so I'm not going to even go over that. Just be aware that the GILTI tax rate would go up. Again, this is an international tax provision. And yeah, this Made in America credit, I'm not exactly sure how this would work, but it's meant to increase manufacturing onshore. So I've seen a little bit on it, but not exactly sure how it's going to work. But I mean, I think the overall consensus is that there's going to be a lot of new credits, and Biden's going to supercharge some of the credits that were already there and create some new ones. So with that, I think that's it. If we have any questions or not.
Thank you both so much for going through that. We do have one question, and Andy, I don't know if you can pull up the Q&A tab.
Oh yeah, I'm looking at it right now. Yep. So question is, if we go back to 2020 employee retention tax credit, which rules do we use, the 2020 rules or the 2021 rules? So 2020's rules have not changed. The only thing that has changed about 2020 is the ability to use it where before you could not if you took a PPP loan. So the rules are exactly the same. The only thing that I will say about 2020 is that we don't know how it's going to work if, for let's say in the third quarter, you had some wages, you would have qualified for the employee retention credit, and instead of doing that, you use those wages in your calculation for forgiveness for PPP. Essentially, those wages have already been spoken for, because again, you can't use them twice. You can't use the same wages for PPP forgiveness and for the employee retention credit. So what happens if I would have used those wages for employee retention credit and I would have used something else for my forgiveness? I maybe would have used some utility payments or some rent or something in my forgiveness, and I still could have got forgiveness. That's the part we don't know. We don't know, again, if you can kind of go back and get a do-over. I wish I had an answer, but I don't. I don't have an answer to that right now. But again, your rules for 2020 have not changed. $10,000 total wages per employee per year, 50% credit. And you still have those differences between 100 employees or less than 100 employees. What is the forgiveness rules for PPP2? Tom, you want to take that one?
Sure, yeah. There hasn't been any updated guidance on forgiveness. I suspect that they'll issue a new forgiveness application for PPP Draw 2s to handle some of the additional expense areas. But at this point, it seems like it's going to follow. There might be some updates on the FTE, but nothing's been updated as of yet.
Okay, so here's
one more there.
Yeah, so if we get the 20% reduction, do we then have to qualify for the 50% reduction? Okay, so this is the employee retention credit again, 2020 versus 2021. So again, you have two different tests. So for 2020, you had a gross receipts reduction of 50%. So back in 2020, if you were trying to determine whether you could take the employee retention credit or not, you had to have this qualifier, or you had to be partially or fully shut down by an executive order. So that was an or test. For 2021, you still have that same test, but the gross receipts reduction has been changed to 20%. Instead of 50%. So now I'm looking at a quarter. We don't have a quarter that's done yet in 2021. But assuming we get through the first quarter of 2021, you would compare that first quarter back to the first quarter in 2020. And if you had a 20% or greater reduction in gross receipts, then you would qualify for the 2021 version of the employer retention credit. It's I will say this, it's very confusing what they've done with the employee retention credit, although it's a good confusing, but it is very confusing because they've essentially it's same credit, it just has different rules whatever year you're trying to look at. So is the dollar amount for PPP2 non-restaurant 2.5 times monthly payroll based on how many months? I received 500,000 in 2020, it would be 500,000 in 2021. Should be the same, shouldn't it, Tom?
Yeah, it's the same calculation. The only difference is, it's non-restaurant. So yeah, it's going to be the same 2.5 times. Now you can use 2020 payroll, but I would say for 90% of people, if you had a sales reduction in 2020 of greater than 25%, 19 is always going to be your higher number. So you stay with the same higher payroll number of 19, should be the same number you used on PPP1 application. So it should really be the same loan amount overall.
I don't see any more.
I don't see any more questions either.
Nope.
Well, thank you both for your time today.
Yeah.
Thank you to our attendees. Again, just as a reminder, we'll make sure that this information is sent out to attendees, and this will also be in our webinars on demand, probably tomorrow. But we'll make sure we get that information out to everybody. And thank you both again, Tom and Andrew, for your time.
Certainly.
This power hour of getting through the round 2 of the PPP, and everything else. So thank you very much.
You're very welcome. Thank you for having us.
Yeah. Thanks for having us. Thanks.
Take care.